Before you is a list of the most influential American corporations. You know them perfectly well and almost certainly use their products. The top 10 of these companies are worth $20 trillion, more than the GDP of China. And here is the Forbes list, which gathers the wealthiest people on the planet. These two lists overlap exactly as one would expect. Here is Elon Musk, and here is his Tesla. Here is Mark Zuckerberg and his Meta. Here is Jeff Bezos in his Amazon. Bill Gates in his Microsoft. There are also less public but well-known individuals here. For example, the Walton family, who own the American hypermarket chain Walmart. So far, nothing unusual. The world's wealthiest people own the largest corporations. However, something strange is happening with some of the companies right here. For instance, in the second 10, the world-famous, though no longer operating everywhere, Visa and MasterCard appear one after the other. But if we set out to find their owners in the Forbes list, we will fail. More accurately, almost everyone here is a holder of the cards themselves, but you will not find the owners of the companies that possess the two largest payment systems in the Forbes list. You won't find the owners of Boeing, the world's largest aircraft manufacturer, either. Nor will you find them for the Procter Gamble holding, which supplies half of all household chemicals to our shelves. The same applies to the PepsiCo Group, which produces not only the famous soda of the 80s generation, but also a mountain of other products found in every store.
Doesn't it seem strange to you that none of the shareholders of these world-famous corporations can be found among the wealthiest people on the planet? Well, let's try to find out who actually owns these firms. To do this, we shall go where information on all American companies is gathered, to the website of the American NASDAQ Stock Exchange. What do we see? Nearly 70% of the Procter & Gamble holding is owned by mysterious institutional investors. We asked ChatGPT who institutional investors are, and we learned that they are investment funds, banks, and insurance companies. This means that Procter & Gamble, Boeing, PepsiCo, Visa, and MasterCard belong to other companies. Well, if we don't stop there, but dig deeper, it turns out that in Alphabet, the company that owns Google, the share of institutional investors is almost 60%. So yes, Larry Page, Sergey Brin, Jeff Bezos, Bill Gates, and Mark Zuckerberg certainly have their shares, which allow them to remain at the top of the Forbes list, but in reality, they are not the sole owners of these companies. To tell the truth, there is nothing unusual about this because any business needs money to grow and expand. A lot of money. And founders take it from investors, giving away pieces of their company through shares in return. Gradually, there are more of these pieces, and the founder's share becomes smaller and smaller. I have here a study from the University of Cambridge which states that 88% of large U.S. corporations are controlled by just 3 companies. And today, I will tell you what these 3 mysterious companies are that own, effectively, the entire American economy. And most importantly, who owns these companies and whether we can somehow participate in the global sharing of the financial pie.
Welcome to a podcast about how the global financial system actually works. May 1930. The United States has been enduring the Great Depression, the largest economic crisis of the 20th century, for almost a year. Millions of people are losing their jobs, withdrawing money from their accounts, and banks are collapsing one after another. And at the very epicenter of this storm, in a small office in Boston, something very strange is happening. Fidelity Shares is being created, a small and almost invisible investment fund organized at the junction of 2 brokerage firms. What is an investment fund? Let's say you have a large sum of money and you don't know how to invest it so that the money works for you. As an option, you can take it to a fund. There sit professional managers who invest for you but take a small commission for it. Then you don't need to understand the intricacies of investing yourself, read financial news, or engage in analytics. Everything will be done for you. And if the fund earns a good profit, then more and more people will want the same and will also bring their money into it, causing the capital under the fund's management to grow. And this is why I say that the creation of Fidelity shares was very strange. Just think about it. Who in their right mind would invest in all sorts of stocks and bonds when the economy is in the strongest crisis in history and people are out of work? However, this did not stop the founders of Fidelity. They invested a little over $40,000 at the start to get things moving. In those days, you could buy a couple of decent houses in the suburbs of New York for that amount. And the fund worked so successfully that in 3 years, its capital grew from $40,000 to $3.5 million. Yes, for a fund, these were still pennies, but more and more people brought money to Fidelity, seeing how it multiplied capital. However, the year 1941 arrives and the United States enters the Second World War. The stock market had only just raised its head after the Great Depression and fell again. But imagine for yourself, what stocks and former businesses matter when a world war is raging? Even the most reliable funds began to suffer losses, and people withdrew their money from investments. Among them, of course, was Fidelity, which could have vanished into oblivion, but at that moment, a young man appears on the scene, Edward Johnson II, a Harvard graduate, a lawyer with a successful career, and a wealth of connections. In short, he had it all. In the early 40s, right after the end of the Great Depression, he personally took part in creating the law on investment funds, and during that time managed to study the financial industry in the smallest detail. Edward understands that it is a crisis that provides the best opportunities. Therefore, when he notices Fidelity, a small but successful fund, he realizes it is an undervalued asset with a good reputation and client base. In 1943, he becomes the fund's manager and begins to change everything. He sells off loss-making assets, fires old managers who had stayed too long, and hires young specialists in their place. He introduces regular reporting, establishes internal standards, and automates document flow. From the client's point of view, nothing changes, but from the industry's point of view, a revolution takes place. Fidelity becomes the first truly modern fund, the kind all investors know today. And Johnson is confident in the future. When the war ends, the market will inevitably come to life, and stocks that now cost pennies will soar to the heavens. The main thing is to survive the storm and be ready for growth. And he was right. The United States would emerge from World War II as a superpower. The country produced almost half of the world's GDP. In its hands were finance, technology, and military power. America builds houses, roads, buys cars, opens universities, and bears children. And all of this, of course, requires materials, machinery, and electricity. Therefore, business begins to flourish and the stock market explodes in its wake. The shares of large companies, General Motors, Boeing, U.S. Steel, make X returns. And along with the American economy, of course, grows Edward Johnson II's Fidelity Fund. And in parallel, his future heir, Edward Johnson III, is growing as well. By a funny coincidence, he and Fidelity are the same age. Both came into the world in 1930. When Edward Johnson III grows up, he will become the head of his father's subsidiary company, the Magellan Fund, which, unlike the risk-free Fidelity, invested in the stocks of small but promising companies. And later, in 1977, when Edward Johnson III becomes the head of all of Fidelity, the Magellan Fund will begin to be managed by his longtime employee, Peter Lynch. By this point, Magellan manages a capital of $18 million. But you must agree, for a large fund, that is not so much. But over the next 13 years, under the talented management of Peter Lynch, the fund's capital increases to $14 billion. To give you some perspective, that is an average annual return of 29% in dollars. That is a staggering figure. But who is this investment genius Peter Lynch, and what is his secret for multiplying capital so effectively? Most likely, the answer to this question is hidden in his books, especially since he has 3 of them. Unfortunately, you won't find any hidden knowledge there, but something else is interesting here. The co-author of Peter Lynch's books is John Rothschild. And what do you think? Is there a connection between Lynch's financial successes and a man named Rothschild among his boss's friends? Well, let's investigate. Today, the Fidelity Fund is headed by Edward Johnson III's granddaughter, Abigail. She owns 28.5% of the company. Another 10% each belongs to her sister and brother. As for the rest of the fund, it is distributed among former and current top managers, including Peter Lynch himself. And this is where curious things begin. But no, the fact that Fidelity is half-owned by former hired managers like Peter Lynch is actually standard practice. Management receives a small share in the firm they lead, so that the value of their personal assets also depends on the quality of their work. And since the fund was founded almost 100 years ago, it is not surprising that during this time, more than half of the company has been given away to its best employees. However, discrepancies in the numbers are observed in the other half of the fund, which belongs to the Johnsons themselves. Look, Fidelity's assets amount to $5.9 trillion, as they write on their own website. Now let's take a calculator and do the math. If Abigail Johnson owns 28.5% of this fund with assets of $5.9 trillion, it means her fortune should be estimated at more than $1.5 trillion. This would raise her to the top of the Forbes ranking by a huge margin, as even the leaders of the list have a mere 100 or 200 billion. But what do we say? Abigail Johnson is in 55th place with $33 billion. Who then owns the other $1.5 trillion? Could it be that same John Rothschild who shared investment secrets with readers alongside Peter Lynch?
Well, it's time to disappoint the conspiracy theorists. John Rothschild is an ordinary journalist. He has no relation to the famous clan. And the real owners of Fidelity's trillion-dollar assets are hidden in a completely different place. But to understand exactly where, one must look at other funds, because Fidelity is far from the only, and moreover, not the largest owner of corporations. This is New York. It is here that Wall Street is located, the heart of the entire financial world. And 85 kilometers to the north lies the prestigious North Salem district, where celebrities and billionaires of all kinds like to visit. For example, Bill Gates and Michael Bloomberg bought plots here for their daughters. There are also many horse farms here, as many as 56 for the whole district, so it is not surprising that the most popular hobbies here are horseback riding and horse walks. However, there is an estate like this here. It would seem there is nothing surprising about it. No popular bridle path passes through its territory. Once, this path was blocked, and one of the neighbors began to protest actively. And when she was informed who owned this estate, she asked, "Well, and who is this Larry Fink of yours?" Indeed, who is he? Larry is a shortening of the American name Lawrence. Let's try to search. Only if we start typing his name into the search bar, the first person we will be offered is the actor Lawrence Fishburne from The Matrix. But while you are all watching that Lawrence fight Neo, an unknown financier named Lawrence Fink was taking the fund he created to the stock exchange. Now he manages assets worth more than $10 trillion. This is the largest and most mysterious fund in the world, called BlackRock. The story of BlackRock's creation begins very much like a Hollywood movie. 1986, 33-year-old Larry Fink is building a brilliant career at First Boston Bank, becoming the youngest asset manager. Remember, in the previous chapter, I mentioned Edward Johnson III, the son of the head of Fidelity. He also took over the Magellan Fund at age 33. The only thing, unlike Johnson, Larry Fink was nobody's relative. Despite this, he too was entrusted with a piece of the bank's assets to manage. So, Mr. Fink successfully manages the portfolio, his career takes flight, and already many are predicting he will take the position of head of the company. But suddenly, Larry makes a wrong forecast. He thinks the interest rate in the United States will fall and buys bonds which are supposed to become more expensive because of that. But the rate, on the contrary, is raised. And Larry Fink burns about $100 million of his clients' money, which he had invested in the bonds that lost value. And that was the end of Fink's banking career. They didn't fire him, but they made it clear that such an investor was no longer welcome there. Therefore, after a couple of years, in '88, he left on his own.
Nevertheless, experience is something you can't just throw away, and so in that same year, Larry Fink teams up with former colleagues from First Boston and creates a new asset management firm. But this time, it was his own. And if before he managed only a piece of a huge bank's assets, now he became the manager of the entire portfolio. True, it wasn't so large yet. The traumatic experience of losing $100 million was firmly etched into the young financier's memory, and therefore, in his new company, he placed risk management at the forefront.
The foundation of the company became the automatic risk management system, Aladdin. Today, literally all data about the markets flows into this system. What the largest funds bought, why Bitcoin went up, what Trump said, what the weather in New York will be tomorrow, and so on. And it is thanks to this system, which one can look into like a crystal ball, that BlackRock was able to turn into the largest fund on the planet. In the next 10 years, things go perfectly for BlackRock, which is exactly what Larry Fink named his company. The American market in the 90s grows several times over, and along with it, BlackRock's assets grow. And if in 1988, at its founding, the company's assets were worth some $100 million, by 98, they exceed $100 billion. And in 2006, they reach $3 trillion. That is, in almost 20 years of existence, the fund grew 10,000 times. But the real finest hour arrives in 2008. First America, and then the entire developed world is overtaken by the mortgage crisis, which became the largest financial shock in history since that very Great Depression of 1929. Real estate prices, which had flown into space in previous years, dropped sharply, and along with them, the price of papers tied to them collapsed. Practically all banks and funds had accumulated such a huge number of them by that point that due to the devaluation, most found themselves on the brink of bankruptcy. In the end, more than 400 banks ceased to exist, among them Lehman Brothers, a financial giant with a century-and-a-half-long history, which was one of the 4 largest investment groups in the United States. Those who managed to hold out fired employees en masse and asked the government for help. Meanwhile, BlackRock asked for no help but also began to buy up other asset management companies, continuing to increase its portfolio through this and turning into the largest fund on the planet. Larry Fink seemed to know this would happen. Moreover, BlackRock received an order from the American government to evaluate and sell toxic state assets, for example, issued loans for which no one would ever return the money. And it seems that the loss of $100 million in the distant year 1986 became Lawrence Fink's best investment, thanks to which his fund and the Aladdin risk management system brilliantly overcame the 2008 crisis and became the #1 asset manager on the planet. And some might think that Larry Fink was just lucky because he happened to be in the right place at the right time. But that's not true. Because while others panicked and sold their assets, Larry Fink was ready for it and bought them up on the cheap. So far, the entire story about him looks like an ideal success story from the books. Lose everything, then create your own firm from scratch, go through all the crises, and become the owner of the largest fund in the world, whose assets now amount to more than $10 trillion. Except, there was no Larry Fink at the top of the Forbes ranking, and there still isn't. To find him on that list, you would have to scroll for a very long time. Lawrence Fink occupies, do you know which line? The 2,623rd. His fortune is $1,200 million. No, the sum is certainly solid, but it is 27 times less than that of Abigail Johnson from Fidelity, and this is despite the fact that BlackRock's assets are almost twice as large. You have probably already guessed the explanation here. Lawrence Fink owns only 1% of the BlackRock fund. Yes, he is its founder, but everything was created with shareholders' money, the largest of which, at the beginning of BlackRock's journey, was the Blackstone Financial Group. And it was as part of Blackstone that BlackRock was created in 1988. In fact, for the first 4 years of its existence, it even bore the name Blackstone Financial Management. However, it too has long ceased to be the owner, because in 1994, it sold everything to the PNC holding. As Blackstone co-owner Steve Schwarzman later put it, it was a heroic mistake.
And then BlackRock went public, thanks to which its shares could now be bought by anyone interested. And then a merger occurred with another financial giant, Merrill Lynch, as well as many other purchases and takeovers, so today's shareholder structure of BlackRock has practically nothing in common with the time of its creation. Today, 3/4 of the BlackRock fund belongs to those same institutional investors. Among the largest shareholders, we see literally all the financial corporations of the USA. Here is Bank of America and Wells Fargo, a bit lower, JP Morgan, and they are all among the 4 largest banks in the country. Well, and we will also find financial giants here such as Morgan Stanley and Goldman Sachs. And of course, our old acquaintances, the Fidelity Fund, are here as well. In short, one can say that the world's largest fund is under the collective ownership of many smaller banks and funds. Fine, but then that means BlackRock is managed by some of these other companies. Let's look at who owns them, and maybe then we will find out the real owners of BlackRock. And here the oddities begin again. At Morgan Stanley, the 4th largest shareholder is that very same BlackRock. At Bank of America, it is the 3rd. At Goldman Sachs, JP Morgan, and Wells Fargo, it is the 2nd. It is also the 2nd at State Street. That is, State Street is among the 3 largest shareholders of BlackRock, and BlackRock is among the 3 largest shareholders of State Street. It turns out to be some kind of global financial centipede. But as if that weren't enough, look at this. The 3rd largest shareholder of State Street is State Street itself, and the 2nd largest shareholder of BlackRock is, yes, you guessed correctly, BlackRock itself. That is, the fund owns itself. It turns out to be a strange and tangled picture. For every large bank or fund, the main owners are also large banks or funds, including themselves, and everyone owns everyone. But where then is that ultimate beneficiary who owns this entire closed circle of shareholders? Or is his name so skillfully hidden? Well, in showing these lists of shareholders, I hid one more name, and for almost all of them, it is listed as the first. This is the ranking of the largest companies that manage various assets. In the first spot already stands the BlackRock you know. Whatever public company you take, you will almost certainly meet this fund among its largest shareholders. Thus, in Apple, Microsoft, and Procter Gamble, almost 8% of the shares belong specifically to BlackRock. These are all millions, even billions of dollars. That is why BlackRock is often called the master of the world economy. But in the shadow of this BlackRock of global finance, another fund lurks, and it is far more mysterious, and its name is Vanguard Group. This is the company that owns 9% of BlackRock. It might seem like just another player from Wall Street, which likewise belongs simultaneously to everyone and no one. But here's what's interesting. If we look at the company card on the NASDAQ exchange, we will see only a dry summary of 6 lines. No reporting, no financial indicators, and no section with owners. Just compare for yourselves the BlackRock card. There is literally everything here. Quotes, dividends, income, press releases, and most importantly, a section with the owners. The same can be seen on the pages of State Street, JP Morgan, Goldman Sachs, and other financial giants. But about Vanguard, nothing. 6 lines. That's all you need to know. And the thing is that Vanguard is a private company. It is not traded on any exchange, which means it is not obliged to disclose full reporting, including its list of shareholders. Actually, this is a quite normal phenomenon, while, for example, there is IKEA, whose shares you cannot buy on any exchange, or the companies Bosch and Mars, which belong to the descendants of Robert Bosch and Franklin Mars. Why look far? Take that same Fidelity fund I told you about. It is the same kind of private company. But despite this, we know the shareholders of Fidelity at least approximately. Let me remind you that half of the company is in the hands of former managers, and the other half is the property of the Johnson family, who, while not the most public figures, are people about whom information can still be found.
But about the owners of Vanguard, there is simply no information at all. Now put this video on pause and try to search for yourself who owns this 2nd largest fund in the world, and write in the comments what you dig up. Well, how are the results? Most likely the first person you met was this influential gentleman. I must admit, in this photo, he indeed looks like a real master of the world, a textbook capitalist, as if he stepped off Soviet propaganda posters. John Bogle is as much a legend of Wall Street as Peter Lynch. He also wrote a series of books on investing and also founded his own fund 50 years ago, which he named Vanguard Group. His biography echoes the story of Larry Fink. For more than 20 years, Bogle worked at the Boston fund Wellington, which he himself headed in 1970, and the end of his career, and simultaneously its new beginning, was the oil crisis of '73, when Middle Eastern exporters of black gold increased prices several times and thereby launched an inflation spiral in the USA and Europe. The quotes of American companies flew down, and the fund under Bogle's management lost a fifth of its value. And if Larry Fink's losses were $100 million, Bogle's amounted to $600 million. And in January '74, he was fired from his post. Soon after this, an antique print dealer knocked on his door and left a book about the triumphs of the British fleet. Bogle began to leaf through it and came across a painting of the Battle of the Nile in which Admiral Nelson's battleship named Vanguard participated. An excellent name, Bogle thought, and founded a fund of the same name. Well, then, you and I have finally found out who, through a chain of funds, is the ultimate beneficiary and the largest owner of practically every Western company. Is John Bogle really that very person who manages the entire global economy? Or is he not, after all? As you probably guess, with Vanguard Group, everything is also not so simple, and the first thing I can state with absolute certainty, Mr. Bogle does not own this fund. Why am I so sure? A very simple, prosaic reason. On January 6, 2019, he passed away at the age of 89. But if so, surely he was able to pass all his assets to his heirs, right? Fortunately, there are plenty to choose from. Bogle left a wife, a brother, 2 sons, 4 daughters, 12 grandchildren, and 6 great-grandchildren. It sounds like the premise for a TV series in which they will fight for the right to manage the global financial system. Oh wait, it's already been filmed, Succession, but not based on Bogle's life. But here is the problem. If Rupert Murdoch, who served as the prototype for the main character, has heirs whose fortune is estimated at $23 billion, then Bogle's wife's fortune amounted to 80, but not billions, millions. That is 15 times less than Larry Fink's, despite the fact that Vanguard's assets are almost the same as BlackRock's. And Lawrence Fink, let me remind you, owns only 1% of the fund he founded. In Bogle's case, it seems this share was even lower, if it existed at all. And here a reasonable question arises. How could he not own the company he founded? Whose money, then, was John Bogle managing? Who are those people who own the assets of his fund worth almost $10 trillion? And if we add to this the assets of BlackRock as well, we get a sum that exceeds China's nominal GDP.
The answer will surprise you. It is hundreds of thousands of ordinary people. This quote is attributed to John Bogle. Don't look for the needle in the haystack, just buy the whole haystack. But so far, the impression is that Bogle himself didn't have even a haystack named Vanguard, let alone a needle in the form of a piece of it. To understand how this happened, let's look a bit more closely at his history. The BlackRock fund became #1 after the 2008 crisis, largely thanks to its automated risk management system, Aladdin. And what about Vanguard? How did it manage to rise to second place? Probably, like Larry Fink, John Bogle also reconsidered his attitude toward risks after losing $600 million. No, his approach was more radical. Bogle decided that risks do not need to be managed. Moreover, the fund itself does not need to be managed. It is enough to do one single thing, simply copy the index of the largest American companies. For example, one such as the S&P 500. This index combines 500 leading U.S. companies and shows how the entire American market feels. Instead of guessing which stocks will grow, Bogle suggested investing in all of them at once, in winning at the expense of economic growth. Speaking about the needle in the haystack, Bogle meant that there is absolutely no point in seeking out firms that will give you super returns. Just gather all the companies into your portfolio bit by bit. That is, buy the whole haystack. This is exactly what he did. He bought all the stocks that were included in the S&P 500 at once. We are not talking, of course, about buying the companies in their entirety, but only tiny parts of them, but all 500 at once. Thus appeared the world's first index fund, Vanguard 500, which still operates today. If you look at the chart of its growth and compare it with the chart of the S&P 500 index, they are, unsurprisingly, identical. At first, other managers treated this idea skeptically, even laughing at Bogle. "We're hiring the coolest analysts here to beat the market, and he doesn't even try to do it, the loser." But soon it was discovered that the number of people wanting to ride along with the index and earn from its growth was becoming larger and larger. Why? Because beating the market on a consistent basis is incredibly difficult. Active investors pay for analytics, traders compete with each other, and becoming the best is not simple at all. Not to mention that to buy all the companies in the S&P 500, you would need a fortune. But an index fund solves this problem. It simply buys the shares of all companies from the index and doesn't spend money on expensive analysts. Non-existent analysts don't make mistaken trades, and the fund doesn't try to beat the market. The economy grows, the portfolio grows. Therefore, most active funds in the long run lose to passive ones in both profitability and stability. To be fair, a fortunate timing of the launch helped Vanguard's success. Quite recently, managers had survived a collapse during the oil crisis of '73, and their clients were disappointed by the loss of money. What is the point of paying commissions to professionals if they lose money anyway? Better to just invest it in an index, which, over the long haul, always grows. Isn't that right? The S&P had just begun to recover after that fall, and exactly such a tool is what John Bogle offered. Vanguard had the lowest commissions, less than 1%, because there were no bonuses to pay to analysts. Anyone can handle the task of buying up shares in the necessary proportion.
Over time, Vanguard began to launch other index funds, from foreign stocks, bonds, and so on, and now their website offers more than 360 investment products. And here it is time finally to understand what these products are. They are hidden under this abbreviation, ETF, which stands for Exchange Traded Fund. The essence is as follows. First, Vanguard gathers bit by bit on the exchange the shares of all companies that are included in the index, and then it splits the resulting portfolio into many equal parts, those very ETFs, and sells them to anyone interested. Theoretically, you could do all this yourself, but imagine how much money and time you would need to have. Therefore, Vanguard does this work for you. Instead of cooking a huge pizza at home, you buy yourself a small slice of it. By the end of the 90s, the S&P had grown more than 3 times in 10 years. First, Wells Fargo, then Fidelity, and then others decided to join the industry. And today, the ETF market is shared by Vanguard, BlackRock, and State Street. And when, looking at the owner card of any large company, we see this trio, in reality, behind it are hidden millions of large and small investors. These companies themselves are not the owners, but only providers. They earn on commissions. This is precisely where the secret of Abigail Johnson's fortune lies. She owns the provider, not the assets. The same goes for Larry Fink. And yet we still haven't answered the question, who is this mysterious owner of Vanguard? Not of the fund's assets, but of the provider itself. The key to the solution lies in the ownership structure of BlackRock. Remember that strange centipede? One of the largest shareholders of the BlackRock fund is BlackRock itself. This is possible because some of the shares of the provider itself are packed into the exchange instruments it created. That is, BlackRock doesn't own itself. It is owned by its clients who bought products that contain BlackRock shares. But Vanguard stitched 100% of its shares into its products. Therefore, on their website, they proudly state, "Our company belongs to the funds which belong to the holders of Vanguard funds." This is a kind of corporate communism. Anyone can buy a piece of the Western economy. For citizens of Russia since 2022, this path has been made difficult, but we have our own alternative, PIVs, Unit Investment Funds. They have existed since the 90s and manage assets worth trillions of rubles. But one person was found who was not satisfied with this scheme. He didn't want to manage other people's money. He himself wanted to own the world's largest corporations. And everyone has heard this man's name, Warren Buffett. 20% annual returns in dollars consistently for 60 years.
His company, Berkshire Hathaway, has bought up assets worth over $1 trillion. How did he manage to turn someone else's portfolio into his own? The key can be found in Wikipedia. Berkshire Hathaway's main business is insurance, specifically the insurance of mega catastrophes. In classic funds, investors can withdraw money at any moment, but clients of insurance companies can only withdraw money when an insured event occurs. And until a mega catastrophe happens, Buffett moves this money around as he pleases. This portfolio belongs not to the clients, but to the insurance firm itself, and it, in turn, belongs to Warren Buffett. That is the whole secret. However, things are not quite so smooth with our ETF providers either. At the beginning of the video, I said that 88% of S&P 500 index companies are controlled by just 3 funds. But what is meant by the word controlled? The budget of any country is the taxpayer's money, but the government disposes of it. Who manages a corporation? The CEO. Who appoints him? The board of directors. And who is on it? Representatives of the largest shareholders. Ordinary clients of BlackRock or Vanguard have no idea who these people are or how they vote. There is no big problem in this yet. The companies are working successfully, and yet real control is shifting toward the financial giants. Surely many were waiting for the exposure of a complex scheme tracing back to the Rockefellers and Rothschilds, and you got only one Rothschild, and even he was the wrong one. But reality is always duller than conspiracy theories.